Hello, entrepreneurs. Joe DeChara coming to you live once again from downtown Flushing, New York for another amazing version of How to Win at Business. And I just love doing this. And today, folks, if you're watching live, give me a hashtag live. If you're watching the replay, give me a hashtag replay. And if you're not watching, don't give me any hashtags. It's your loss, I'm sorry to say, because we got some valuable content to go through today. You know, people get audited, unfortunately, and sole proprietors get audited more than anybody. And today I came across a case that seemed pretty interesting, and it highlights part of the problem with being in business and being classified as a sole proprietor. So also let me mention, if anything that I talk about resonates with you, if you ever want to book a free chat with me, feel free. Go to timewithjoe.com. I love talking about business, about taxes, about how to beat the machine, how to beat the IRS at their own game, and that's one of my stories. I'm looking for. Okay, let me find a way to share this. So what happens is when people have a sole proprietorship and they want to write off legitimate business expenses, and we're not going to even go there yet. But this is what happens when people start a business. Most of the time, people start a business and never even make any money. First of all, they make zero revenue. That's one area. Or they just have expense. They make some money, but they have more expenses than their income, which means that they're showing a loss. And that can go on for years, and sometimes they never even recover. They just lose money and go out of business. Well, if you're in business, you're entitled to business deductions, unless you're a sole proprietor. And I'll tell you what I mean by that. They have something called the hobby loss rules. You see, when you go into business, it's supposed to be to make a profit. You have a profit motive. Well, if you never make a profit, what the IRS is saying is that you're not really a viable business. Unless you're a corporation. Corporations lose money year after year after year after year. And that's a good thing for them because they don't want to pay taxes. There's ways to create losses. Sometimes they pay their officers, and I don't even want to get into that. What I'm talking about are the smallest of small businesses, the sole proprietors that struggle just to create some kind of revenue so that they have a profit, and then they file their returns. Well, according to the IRS, if you haven't made a profit in 3 consecutive years, they're going to consider it a hobby. Even if it's a trucking business, they're going to say, "Oh, you're a hobby." It's in the rules. I don't think it's it's sort of like one of the rules the IRS tells you is a rule, but it's not really a rule. It's something that they go by. They're like, okay, if you've lost money, you're a red flag. That's what it is. Because I've seen plenty of people file Schedule Cs as sole proprietors for years, 5, 6, 7 years, and only have losses, and they never got audited. That was just luck that they didn't get audited. Maybe they didn't have, maybe it just wasn't worth it for the IRS to spend the time, whatever. But a lot of times they do get audited. And in this one case, so I'm gonna share the screen now with this case, because what the IRS said was basically, let's go up here. So this was a case about a taxpayer who had an insurance business. He had a profitable insurance business, and he woke up one day because he's an entrepreneur. I said, I really like that stuff we did with horses when I was a kid. I think I want to turn that into a business. And, anything with horses is expensive. It costs money. And it takes years. It could take years before you start making a profit. Now, what this guy did was he took the deductions because he said, I am in business. Uh, he had, so I'm going through the facts of the case, but this is what it came down to. The IRS said, okay, the taxpayer argued that he had a business plan, and he had a written business plan. You know, he wasn't a brand new entrepreneur. He was a seasoned veteran. He had done this before. And he said he had a business plan, he had employees, he was going to train, he was going to go into competition, and those things cost a lot of money. And he probably came up with a big loss. And he didn't make money, and they audited him. So what the IRS claimed is the main question is whether the taxpayer intended to turn a profit. He asserted that he was competing in a sport where he was likely to win and had a business plan to improve and win some more. The IRS contended that any hope for an ultimate profit was weighted with so many improbabilities that it could not reflect a genuine profit motive. Well, why do they have professional gamblers then? You could be a professional gambler and write off your business expenses. So, but this went all the way to the tax court. So they said that now I'm pretty sure that they could appeal this, but what the IRS says is there were 9 points, and I'm gonna copy these and put them into the chat. I don't know if that's gonna work, but let's see. So yeah, it didn't come out as as bullet points, but that's what they're saying. The manner in which he carries on the expertise, the time and effort expended by the taxpayer, their expectation that assets used in the activity may appreciate in value. I don't know what that means. I mean, I know what it means, but the success of the taxpayer in carrying on similar or dissimilar activities, the taxpayer's history of income and losses, the amount of profits earned, if any, the financial status of the taxpayer, any elements of personal pleasure or recreation. And I think that was the killer for him, because when he grew up, he was doing these horse things as a hobby. It was a hobby. How he lost his case, I don't know. But the fact that it made it to the tax court is really the issue. You see, folks, if he was an S-corp, he would have never got audited. That's my story, and I'm sticking with it. If you're a sole proprietor, you need to not be a sole proprietor. Contact me. Go to timewithjoe.com, and I'll walk you through the process. I'll tell you what it would cost you. It's a lot less expensive than people say it is. It's a lot less complicated than people would have you believe. You know, the government, other accountants, that they all want to make it seem like being a corporation is complicated. Well, it is a little complicated, but you're in business. If you think you're going to go into business and have no complications, you should not be in business. Okay, and that's my story. I'm sticking with it. God bless. This was a quick special broadcast because I found that article and I wanted to share it with you. So I invite you to chat with me, timewithjoe.com, and I also would love to invite you to our mastermind. We have a great mastermind every Saturday, 2 p.m. Eastern. We play Jeopardy, we network, we connect, we have fun, we learn, we grow. And then on Tuesdays, we have Tech Tuesdays, where you get to pick Elizabeth Frederick's brain about all of these different software programs that are available. God bless. I will see you again shortly. Thank you.